Hello and welcome. Before we start, please make sure to subscribe to our YouTube channel for news and updates. To paraphrase Ernest Hemingway, shifts in the stock market often occur gradually, then suddenly. Over the past month, the market has rotated from large-cap technology stocks to small caps and other sectors. Following the latest jobs report, however, global stocks experienced a sharp pullback due to concerns over the timing of Fed rate cuts, a weakening labor market, and disappointing tech earnings. Financial markets are on edge as investors adjust to a changing economic landscape. Ironically, current macroeconomic conditions, inflation returning to 2%, low but rising unemployment, falling interest rates, and double-digit stock market gains, are exactly what investors had hoped for at the start of the year. Now more than ever, investors need perspective to navigate markets and stay on track to achieve their financial goals. How should investors view recent stock market swings as they position for the coming months? Investors need perspective in volatile markets. Investors focused on recent performance alone would no doubt wonder if the cycle is over. While recent market events are still playing out, it's important to remember that not only are stock market swings normal, but they can also be healthy if they are the result of investors adjusting to new economic facts. This is especially true if valuations improve as prices adjust and corporate earnings continue to grow. As the accompanying chart shows, the S&P 500 has gained 113% over the past 5 years, including the pandemic collapse and the 2022 bear market. While market pullbacks are never pleasant, viewing the market on these timescales does help to put the current decline in perspective. So far, market fundamentals still appear to be strong, regardless of how stocks move in the short run. Profit forecasts are still positive, with S&P 500 earnings expected to grow 13% over the next 12 months. More than half of S&P 500 sectors are expected to grow earnings by double digits, and all 11 sectors are forecasted to experience positive growth. In the long run, earnings are what drive stock market returns, and thus the health of the economy matters more than short-term stock and sector-specific trading activity. Concerns are growing that the Fed has made a policy mistake. This is why concerns around the Fed have spooked the market in recent days. The Fed has now kept rates unchanged for over a year as it seeks greater confidence that inflation is returning to its 2% target. However, its focus on inflation is now resulting in a weakening labor market, which some fear could spiral toward a hard landing. The year began with investors believing the Fed would need to cut rates several times due to an imminent recession. Expectations then shifted after a few hotter-than-expected inflation reports, with investors believing the Fed would not cut at all this year. Today, markets expect the Fed to cut in September and possibly at each subsequent meeting. These swings show how difficult it is to get monetary policy right, even as backseat drivers. One reason economists are concerned about this increase in unemployment is an economic indicator known as the SOM rule, shown in the accompanying chart. The SOM rule, named after a former Fed economist, predicts the onset of recessions based on the trend in unemployment. The simple intuition is that a sudden jump in the unemployment rate is highly correlated with economic downturns. In fact, the very definition of a recession depends on the state of the job market. Additionally, SOM herself has stated that this is more of a historical regularity and not a hard and fast physical law. Where does the Fed stand today? Very few argue that the Fed has made the wrong moves per se, just that they have not timed them well. While many may wish the Fed had cut rates at its last meeting, it is likely they will do so soon. Investing is about both returns and managing risk. Investing is never a sure thing. In the classic book, A Random Walk Down Wall Street, author Burton Malkiel writes that the stock market is like a gambling casino, where the odds are rigged in favor of the players. Investing in the stock market comes with many risks that can be managed with proper portfolio construction and a long-time horizon. History shows that despite the ups and downs of the market, staying invested is still the best way to grow wealth and achieve financial goals over the course of decades. Stocks never move up in a straight line, so how we react to market volatility is perhaps more important than the volatility itself. The S&P 500 has now experienced its second 5% or worse pullback this year. As the accompanying chart shows, this is below the average of 4 to 5 pullbacks experienced in the average year, and the dozens during bear markets. Additionally, current market concerns driven by tech stocks, the Fed, and the labor market all have their silver linings. The economy is still quite healthy, corporate earnings are still growing, and if interest rates do sustainably fall, many other parts of the market could benefit. As in past episodes of volatility, seeing past the current market moves and headlines is needed to benefit from the long-term trend. The bottom line? Recent economic data have sparked concerns that the Fed should have cut rates sooner. Tech stocks have also declined as investors worry about valuations and earnings. In volatile markets, it's important for investors to stay level-headed as they work toward their long-term goals. Thank you for listening. For additional information, please visit mraadvisory.com.